Hi everyone, my name is Speziale and I'm the national best-selling author of Market Masters. You can pick up my book at your favorite bookstore or online at Amazon.com or Amazon.ca. In this video, I'll be talking about my 72 rules for investing in stocks. Now, I've split up my 72 rules into a three-part video series, which you can all find on YouTube. For part one, this video, I'm only going to be talking about rules 1 through 25. And you can get a free copy of my new book, Capital Compounders. Find my email in the description to this video. Shoot me an email and I'll send you the free book, and you can find all of the rules written in there. Here we go, my 72 rules on investing in stocks. Rule number 1, I'll only hold 25 to 40 core stocks in my portfolio, because at that point, I'm well diversified and I'm not diluting my portfolio with so-so picks. I have high conviction in my current holdings. Plus, I can more easily follow 25 to 40 stocks on a quarterly basis than I can 40 plus stocks. Any number above that and it becomes a circus to manage. Number 2, I don't let any stock grow larger than 10% of my portfolio. That opens me up to potential risk. My winners will approach 10% position size as they grow, so I take profit off the table and allocate those funds to my new emerging growth opportunities. Number 3, I only invest in companies where I can confidently project future cash flows. I can't confidently project cash flows for companies in cyclical industries like mining, financial services, and pharmaceuticals, etc. I lost a lot of money in London mining in 2007, 2008, the commodity bust. I lost a total of 85% on that particular stock. I learned my lesson, and now I avoid the mining sector like the plague. But some investors actually make money on junior mining stocks. Robert Hirschberg, a family friend, for example, in the video in my book, which I linked to, Robert explains how he parlayed $20,000 into $15 million speculating in junior mining stocks. Robert explains the 4 things he looks for in a junior mining company. Number 1, executives with successful track records building up junior companies. Number 2, good assets. Number 3, access to funding. And number 4, lots of upside, quote unquote, blue sky potential. I find it funny when I see complex Excel models that project 10 years of cash flow in unpredictable businesses. That's like putting lipstick on a pig and an ill-fated attempt at fortune telling, especially when past earnings haven't even been consistent, like 10% growth in 1 year, 50% in year 2, and then negative 10% growth in year 3. Those earnings are volatile, and volatile earnings disable my ability to project the path of future earnings in a company. Rule number 4, similarly, I don't invest in price takers, like oil and gas companies that have to price what they sell based on prevailing crude oil market prices, but rather I invest in price setters, those companies that can raise prices year after year to generate higher revenues. Think about companies like Tim Hortons and Starbucks and McDonald's. Rule number 5, there's only 2 ways a company can continually increase revenue over time: by raising or increasing volume, whether that's through increasing the number of customers, average transaction size, or transactions per customer. I invest in companies that can achieve both price and volume growth. I like analyzing revenue because it's virtually impossible to fudge top-line revenue figures through financial engineering like it can be done with net income and profit figures. Further, revenue needs to be sustainable and recurring over time. I don't like lumpy and inconsistent one-off revenue. To illustrate, I find it amazing that a dollar store, Dollarama for example, can consistently do both: increase its store count, volume, and its prices, higher than $1, over time like clockwork. That's why I'm a happy Dollarama shareholder. Rule number 6, I really like companies that can expand globally. Think about a company's products and services addressable market. The growth potential is enormous when the addressable market is virtually everyone in the world. That's why companies that become near monopolies with little to no competition, like Google, are ideal investments, especially at early stages in their business life cycle. The companies that I invest in need to have a competitive advantage, whether that's through their operating model, distribution network, brands, niche product services, patents, technology, regulatory protection, goodwill, etc. I ask myself, how hard would it be for a competitor to take any of their business? And can technology or innovation disrupt this company's business model? I also employ Porter's 5 forces to validate a company's competitive advantage. Porter's 5 forces should be analyzed for any weaknesses as shown: threat of new entrants, threat of substitutes, bargaining power of customers, bargaining power of suppliers, and industry rivalry. Rule number 8, cost cutting isn't a business strategy. Companies that cost cut to generate profit and appease the street for however long aren't worth my time. You can only cut costs so much until there's really nothing great that remains. I want revenue growth. Companies that are growing are hiring, investing, and spending. Rule number 9, I don't invest in any industries or traditional businesses that are going bust. Newspapers, anyone? And as of late, department-sized brick and mortar stores. The best case study is the blockbuster to Netflix virtual wealth transfer. That's why I always invest in relatively new businesses and avoid mature business models. I want to invest in the wealth recipients, like Netflix in that example. Thomas Rowe Price, who is the father of growth investing, said that it is better to be early than too late in recognizing the passing of one era, the waning of old investment favorites, and the advent of a new era affording opportunities for the investor. Rule number 10, companies should be earning high rates of return on capital, generally around 15%, and at a minimum above their cost of capital, consistently over at least 5 years, and preferably over 10 years. Example, 15%, 16, 15, 16, 15, 16. You get the point. But on an aggregate basis, I want to see around 15% return on capital, and higher is obviously preferred. What happens at the company level, this is rule number 11, needs to also occur at the per share level. For example, growth in net income translating into an increase in earnings per share, EPS. In addition, neither net income nor earnings per share should be negative in the past 10 years. If there exists an outlier, only 1 year of negative earnings should be accepted, but only if that earnings period resulted from something extraordinary and will not repeat based on your judgment. Along the same lines, I want to see an increase in book value per share and free cash flow per share over time. Some management dilute their existing shareholders through mass expansion of shares outstanding. In other words, using the shares irresponsibly as currency, and I don't like that. Rule number 12. I focus my picks in the more inefficient small cap and mid cap segments. Those are the smaller market capitalization companies, $100 million to $10 billion in size, that can double, triple, quadruple, and more on the stock market. If I owned large cap companies only, those that are $10 billion plus, I would just be replicating the index, like the S&P 500 and its performance. Rule number 10, when there's a systematic market decline, like a recession we saw in 2008, or a bear market like the one we saw in Canada in 2015 because of the crash in crude oil prices, or a common correction, which happens occasionally, I'll invest more money into my existing stock holdings. I'll happily buy great growth companies at cheaper prices. But when an individual stock drops in price among a normal range market, I think long and hard before investing more money. Dollar cost averaging, as it's called, because, rule number 4, because managing our portfolio is like gardening. Instead of watering my weeds, I water my dandelion. I water my dandelions so that they can grow bigger. In other words, I reward my existing holdings, the winners, by increasing my stake in them when they post great earnings results quarter after quarter. I like to see 15% plus earnings per share growth. And I also like a beautiful garden. Number 15, underperforming cheap stocks, those weeds we talked about before, can get cheaper and cheaper and cheaper. And they're probably getting cheaper for a reason. That's called a value trap. And I don't like getting trapped. Not all stocks bounce back, as some investors hope and pray. Take a look at Citigroup. It went from $550 per share 2007 to $25 per share 2009 as a result of the financial crisis. and it's only at $60 per share now, 2017. That's a terrible crash, and a paltry rebound, if you even call that, as Citigroup is nowhere near its $550 high. For another example, take a look at Crocs from its peak in 2007. It really pains me to see investors trying to catch a falling knife, like in Citigroup or Crocs examples, thinking it's a so-called value stock. I'm always happy to pay a little more to invest in a quality growth stock because I'm buying a company's future cash flows, not just what it's worth today. Rule number 16, the companies that I invest in don't have a lot of long-term debt on their balance sheets, preferably no debt at all. Overall, tightly controlled and clean balance sheets. Furthermore, I like to calculate a business's current ratio by dividing its current assets by its current liabilities. A figure in the range of 1.5 to 2 is healthy, whereas 2 to 2.5 or more is ideal. Free cash flow is king. Rule number 17. Companies that generate high amounts of free cash flow combined with exceptional capital allocation can grow at high rates through reinvestment in their business, smart acquisitions, and opportune share buybacks, especially if shares are canceled for a prolonged period of time. Plus, lots of cash means companies can self-fund their business, not having to heavily rely on the debt or equity markets, even throughout economic down cycles when credit dries up. Exceptional free cash flow generators are usually those companies that require less capital expenditure to run their business. High capital expenditure intense businesses like airlines are sluggish, requiring much too much capital to grow, and even then deliver low returns and never really take flight. I'll pass. Rule number 18, the free cash flow to enterprise value ratio, which is free cash flow over enterprise value, might be one of the best but overlooked metrics one can identify exceptional and inefficiently priced capital compounder stocks. The higher the percentage figure, the better. That combined with high return on capital to demonstrate effective allocation of free cash flow. Number 19, buy and hold forever doesn't work. Sure, Warren Buffett says that his favorite holding period is forever, but what he says isn't always what he does. Recent case in point, look at IBM in 2017. He had sold a major chunk of IBM, and I believe he might be completely out of it now. I understand that businesses don't last forever. As Chuck Palahniuk wrote in his famous book Fight Club, on a long enough timeline, the survival rate for everyone, including businesses, drops to zero. It's basic high school business class curriculum, where we learn companies go through various stages and linear stages at that, from seed to startup to growth to established to expansion to mature and then exit. Look at the Dow Jones, S&P 500, and other major indexes over history. Companies are listed and delisted over time. So I make money when I can from growth through expansion and don't hold on to dying companies past their maturity because that's like drinking spoiled milk. Rule number 20. I always strive to maintain around a 15% compound annual return in my portfolio. If one of my stock holdings isn't keeping up with the pace, I'll sell and allocate those funds into a company that can generate high returns. I'm always thinking about opportunity cost, where money can work the hardest for me at any given time. Generally, a company's compound returns are correlated to its return on capital. That's why the stock holdings in my portfolio average 15% on capital, because I want to achieve a 15% compound annual return, at least. Though it's important to note that I find any compound return over 15% isn't really sustainable in the long term. I would be taking on too much risk to achieve that hurdle. Don't try to be the hero, as one of my friends would say, reflecting on his own attempt to achieve dangerously high returns in the stock market. Rule number 21. I never invest in stocks just because they have high dividend yields. Most of my holdings have low or no dividend yields at all because capital is used in more effective ways, example, reinvestment into the business. High dividend yields are indicative of large caps, mature businesses, and in some cases, businesses in decline. And in the latter case, companies that slash dividends send their stock prices further into decline, especially if those stocks are labeled as high yielders. Rule number 22, I buy growth at a reasonable price, or GARP, meaning that I won't buy stock with a 25 price to earnings and 10% earnings per share growth rate, but will happily buy stock with a 30 price to earnings multiple and 30% plus earnings per share growth rate. It's all about the growth, but try telling that to a value investor. Rule number 23. Speaking of which, I'm not a value investor. I don't buy obscure nets, as known as deep value stocks that I know nothing about, hoping that the market will see what I see and then finally bid up the price of the stock in line with its underlying net asset value. That could take months, years, never. Number 24. I need to understand each of the businesses in my portfolio. That means most of my stocks, 80% plus of them, fall into these three industries: consumer franchise, technology, and diversified industrials or industries. Some people want to look smart by buying into complex industries like biotechnology, but I like boring and unglamorous companies that generate high return on capital on a consistent basis. Bonus points if they're leaders in their respective industries. Some of my best investments of all time are in companies that I spotted in the mall, supermarket, or just out and about. The products and services that people buy on a recurring basis. You should do the same. Now, I don't invest in the stock market to look smart. I do it to make money, and I buy what I know. Similarly, I don't shy away from buying great companies in the female space, like Estee Lauder. The investment industry consists mainly of men, so I find that I can have an informational advantage in stocks that they might not want to touch or don't know much about. Number 25. Before I initiate a new position, I don't first think, how much money can I make? Instead, I ask myself, how much money can I lose? I consider all the ways the stocks can lose money before I even think about the upside. All right, well, thanks for listening to rules 1 through 25. Please listen to part 2 of this series, where you can learn more about investing and how I go about winning in the stock market. Thank you very much. Talk soon.